Hi, everybody. It's Scott again. And today we're going to do a short update to what was originally our podcast number 4, I believe, where we talked about decoding the latest federal incentives for commercial solar projects. We also, I believe, included some details about state grants, and we used a couple examples. One was a REAP grant that REAP and also a RISE grant, RISE, that were both state-sponsored grants, but were supported by federal money behind it. But for the first one we're going to update is I want to talk a little bit about the solar investment tax credit, because there's going to be an update probably given at least once a week on this channel by me to talk about some of the changes and modifications based on either efforts in the U.S. House and then now in the U.S. Senate. So where we were last week, and I'll just do a very quick recap, but first of all, the original law, in case anyone has forgotten how important and relevant it is the law in place since 2022 is that customers who purchase solar can take a 30% tax credit for eligible costs, and that is in place and is currently in place from 2022 to 2032, with several adders that would contribute on various subjects, including efforts in low-income neighborhoods and also buying either entirely or mostly primarily American hardware that would add 10% to the 30. So that was the original law. Where things stood, where we talked about it last week was, and May 20th was in the House Budget Committee. And at the time, coming into the discussions, there was the proposed budget reconciliation bill at that time would decrease those the investment tax credits and the production tax credits for a number of clean energy technologies after 2028 and phase them out entirely after 2031, as well as additional requirements to qualify for credits and an early sunset for their transferability. That's the transferability of those credits, because at one point you could transfer them into some other form, and the details, I don't have the details currently, but I can provide them to you if you're interested. Just feel free to contact me online. The sunset dates for that phase-in, that modified phase-in, after 2028, we're going to look like this. So 30% tax credit through the end of 2028, followed by, in 2029, sunset dates and phase out over a 4-year period. And that wasn't really that wasn't necessarily terrible news. It wasn't good news because it didn't keep the same 2032 exit date for the entire 30%. But in 2029, it was the legislation on the House side Budget Committee was 80% of the credit values. So now we're down to 80% of the 30%. In 2030, down to 60% of the credit values. In 2031, down to 40% of the credit values. And then finally, in 2032, the credits would be phased out entirely. That was not necessary. That hurt a little bit, but it certainly wasn't necessarily as painful as it could be. It also kept, however, this foreign entity of concern provision. People like to call it the FEO provision, and also a placed in service standard was also included in that draft legislation. The details of when are not necessarily important because we've blown already past that. So now to give you the specifics is what happened at the end of last Thursday. And then this is an update as of yesterday, but as of last Thursday, Republicans in the House of Representatives, who have a majority on pretty much every committee, including the Budget Committee, passed a budget reconciliation bill Thursday, which would further pare back most of the clean energy investment tax credits and production tax credits. That is certainly extremely dire news. Congress is now one chamber away from passing a law that would dramatically increase project risk, reduce investment certainty, cancel previously awarded projects and investments, and stall clean energy development. That was a quote from folks at a company called Clean Capital that posted something online the other day. What this does is it removes phase outs for ITC and PTC. So basically, projects must begin construction within 60 days of enactment of this legislation, which might be sometime in the late summer or possibly later. And also, those projects must be placed in service before December 31st, 2028 to receive the credits. So when I say that, the probable deadline to start construction would have to be in early October of this year in order to qualify for the 30%, which in terms of the way they wrote it would last until the end of 2028 when you could take it. So basically your construction period, which makes no sense, could be from anywhere from the fall of this year, 2025, for 3 years, and you could finish the project in late 2028, still get the 30% tax credit. But that really doesn't make any sense. That's not a phase-in. That is a way for the Republican-controlled House to and Budget Committee and process to basically phase out almost without exception, many projects that would be in a pipeline, say, anytime later this year. So if you don't have a project that is underway, under construction, based on the definition, by the latter part of this year, then you're not entitled to any tax credit at the end of the year. Within 60 days of passage. So it doesn't matter if it's 3 years, or 2 years, or 1 year. You wouldn't be entitled to anything if you can't get the project off the ground within 60 days of passage of whatever would ultimately be the Tax Act, which would include in this reconciliation bill a variety of things, including Medicare, Medicaid, all sorts of other provisions, that span the entire spectrum of issues. But the primary drivers of those issues today are the Medicare and Medicaid, certainly the fate of the Inflation Reduction Act and any other energy-related provisions in anything else that's sitting out there in existing rules or regulations, and then also things that cover things such as the SALT deductions, the state and local tax issues, but there are a wealth of other things that are included as well. There's SNAP money and school money for school lunches that have also taken a massive hit based on the current version and draft of legislation. So there are a lot of things that are under the gun right now, but the renewable piece is absolutely under the gun. So when I talked earlier about the start of construction, one of the details is that start of construction, what would qualify for that. So the definition of start of construction is still satisfied by the two tests in this amended bill, which is either by physically starting the project or incurring 5% of the cost of materials for the project. So some of those pieces are the same, but in terms of the timeline really hurts, and it basically kills most of the industry, by the end of this year, really. It does move up dates for the FEOC compliance, which is the foreign entities of concern compliance, and moves it up to December 31st of this year, of 2025. So this would restrict projects from collecting incentives. And again, this language to me is really complicated, little and very, very difficult, even for most folks who are extremely capable of reading and interpreting these. But it basically says that FIO compliance restricts projects from collecting incentives if they involve only, quote, material assistance, end quote, from a prohibited foreign entity if they start construction after December 31st, 2025. So in many ways, that certainly, putting it all together, the current draft proposed reconciliation bill that has been passed as of Thursday goes to the Senate, where the Senate is going to take their own swipe at it. And there has been a lot of discussion about what that looks like, but the reality is that the provisions as they stand, we would need to see some movement. We would probably need to see a great deal of movement on Probably, interestingly, on the Medicare and Medicaid issues. I think senators that are looking at reducing are reducing the hit to Medicare and Medicaid mean that there's more money that's going back into that. So that means money put back into the bill. That certainly means that there has to be a compromise or discussion about what that's going to look like. It could mean, possibly a reduction in what the tax breaks are, which make a lot of sense because if you're not generating revenue, you can't spend it. But the budget deficit is a huge problem, and raising the budget deficit by increasing any of these programs, whether it's Medicaid, Medicare, or the IRA tax credits, it means giving people money, more than what the Republicans were willing to do as far as that initial reconciliation bill on the House side. So, what really begs the question is, will the Senate take a little bit more of a restrictive view on how much debt they want to put out there and allow the government to have as a ceiling? And then also as a result of that, what are they going to do with the major pieces? The major pieces still come down to really Medicare, Medicaid, the renewable issues, and the commitment to keep the major provisions of the Inflation Reduction Act, which basically do a lot to support our energy businesses and the energy vertical in America. So, and that is not state by state. That is in every state. So taking a really strong look at that, I think we're going to see a lot of talk and a lot of discussion. It appears that a lot of the senators are looking at that, at deficit issues, at Medicare, Medicaid issues, and they're looking at SALT issues, and they're also looking at energy issues. So all of these things, which were affected in a major way on the House side, are gonna be reviewed very, very carefully. I think, hopefully with a much more measured approach than what was taken in the House. So we'll see. In the coming weeks, we'll have more detail and we'll report on that. But that's the essence of it. Is right now, and just to repeat, just to be very clear, the current amended budget bill as of today, the 28th of May, removes the phase-outs for both the ITC and the CTC Projects must begin construction within 60 days of enactment of the ultimate final bill and be placed in service before December 31st, 2028 to receive the credits. Also, the start of construction is still satisfied by the two tests that we talked about earlier, either physically something in the ground or incurring 5% of project cost materials. And also it moves up the dates for foreign entities of concern compliance to December 31st, 2025. So for now, that's the update on the investment tax credit. And we'll move to just one more topic that we did take up in that podcast, and that is the status of things with regard to just one state program. We did talk about the REAP program, but I just want to mention a quick update that I have to what was called the RISE program in Pennsylvania, or RISE PA. RISE stands for Reducing Industrial Sector Emissions in Pennsylvania, and this was a grant program with money that was given from and awarded from the Pennsylvania Department. To the Pennsylvania Department of Environmental Protection, awarded $396 million from the U.S. Environmental Protection Agency, the EPA, to establish this program to reduce industrial sector emissions in Pennsylvania. And so this program seeks to reduce greenhouse gas emissions and co-pollutants from Pennsylvania's industrial sector by over 8 million metric tons by 2050. And so the update that I have is that the programs were broken down into 3 segments. They include the ability to do on-site solar and renewable energy, not just solar. But there were 3 program initiatives, one for small, medium, and large manufacturers. The medium and large manufacturing applications, as of our last podcast on this, were open, and they were accepting applications in Pennsylvania for much, much larger scale and size and dollar amount programs. I can tell you that now the small manufacturing process and application is open, and that's 500 or fewer employees at a plant or manufacturing site, and project costs anywhere between $50 $50,000 and $1 million are eligible for base grants that cover 50% of the total project cost up to a maximum award of $500,000. So that's an incredibly, it's a very large program. We'll see what kind of interest there is statewide, probably very soon, but certainly on the side of the small manufacturing, it's a great opportunity for folks of the smaller sized entities in Pennsylvania and manufacturing firms to get into it and to do something to support and lower the emissions that they have on their sites. And that's the update for the RISE grant as well. Thanks, and we'll see you next week, and we'll have another update, I'm sure, on the investment tax credit.